We're going to talk now to Kathy Jones, Chief Fixed Income Strategist at the Schwab Center for Financial Research. That's an important point, right, Kathy? Because it's inverted in one little spot. Why is it inverted in that spot?
Well, I think what's happened in the last couple of weeks is the slowdown in the global economy has pulled down long-term rates pretty substantially. And then when the Fed signaled that they were pivoting to a stable policy stance for the time being, I think it revived concerns that perhaps the economy is slower than people anticipated, and the next move by the Fed will be a cut, which we think is likely.
Now, let's jump into the terminal because we have the Fed near-term forward spread, which you can see over the last 6 months or a year has come all the way down to, minus 29 basis points it is right now. We'll just swap that out to take my terminal. The point being, Kathy, that we're negative here. What does this tell you as a market watcher?
Yeah, this is something the Fed wrote about last year, that they introduced this near-term forward spread as what they thought was a little bit more accurate than the 3-month 10-year or the 2-year 10-year that the market tends to watch. And it really just tells you about where short-term rates are expected to be in the next 18 months or so. And you can see that it's in negative territory. It dipped there in January, and it's continued to be very low, and it's dipped below zero again. So it does signify, at least the expectation in the market, is that we're going to see the next move be a cut.
Kathy, good morning. Guy in London. What's the gap between rates inverting, the curve inverting, and the point at which you want to start selling equities?
Well, we don't go whole cloth one direction or another, but we came into this year with a cautious stance. So our view was that we're getting late in the business cycle, that we would see a slowdown in economic growth this year, and that some of the fundamentals supporting the market were softening. So our view is more defensive pretty much across the board within fixed income and in equities.
If we were to get a recession in the next 18 months, that would obviously put us slap bang in the middle of the electoral cycle. The president would find it more difficult to get re-elected were he to find himself at that point with a recession. Do you think, therefore, we are going to see more fiscal stimulus? Do you think there's going to be more pressure on the Fed to keep the sugar high going?
Well, I don't know about the Fed, yielding to any sort of pressure. I think that they will continue to watch the economic data, and my guess is that sometime later this year we could see them move towards a cut. As for fiscal policy, it's anybody's guess what's going to happen, but I imagine if things slow down, there might be some pressure there.
Kathy, you say we're definitely getting a cut then. When do you think it'll become necessary for the Fed to do so?
Later this year, I think, is the most likely time. Everyone's sort of anticipating and talking about how the beginning of the year will be slow, but we'll have a soft landing and things will bounce back. But the indicators really aren't pointing in that direction. You just noted that consumer expectations for the future are starting to erode a little bit. We still have the real sharp decline in manufacturing activity around the globe, particularly in Europe. And now we have negative bond yields to the tune of $10 trillion. It's really hard for me to see that the Fed could, unless something changes pretty quickly, that the Fed isn't going to have to cut rates at some stage of the game.